For the 3rd of November 2017. So we're going to start off just looking at the markets today, then review the price action we saw in sterling yesterday following the Bank of England rate hike. However, looking at the chart, you probably wouldn't expect that there was a hike given the sell-off. So we'll discuss sort of why this took place, then talk about some other major data which came out, or news events which came out last night. And in yesterday's session, then we'll finish off looking at the data ahead. Most importantly, we got services PMI from the UK. I say that nice right up there at the beginning of the brief because sterling's already down to test its lows. And as we know, the UK numbers generally, well, everyone assumes that they get pre-released because you see the market move ahead of the data only for you to see, sort of, in this case, sell the rumor, buy the fact, where the price will already majority of the move would have already taken place ahead of the data release actually coming out. So I'd keep an eye on this, but we're talking a little bit more about services PMI going forward. So having a look at the markets at the moment, as I said, sterling testing the lows, which would be sort of indicative of sterling weakness, which is what we saw yesterday, and a bit of dollar strength. The dollar strength argument can be seen in euro dollar, still in the middle of the range. However, since European market participants have come into the market, we've driven the euro just below pivot, just consolidating down here at the moment. Gold is also on session lows. Equity markets, you've got DAX at the moment, just getting through R1, which also was 134.90, just up to test 13,500 at the moment. So this is obviously supported by the weaker euro here. Plus sort of risk on across the board with US equities trading higher as well. Looking at oil, largely mid-range, nothing too spectacular here. But equities moving higher. Well, we saw this in the United States yesterday in the NASDAQ. If we look at after-hour trading, we had Apple release its earnings, and we saw immediate upside in NASDAQ, breaking through pivot and really sitting on its highs coming into this morning. Looks like there's a little stop run here as people were trying to go long the previous high. And if you look at what's happening with Apple shares at the moment, they are here. So after hours, they are up 3.31%. So this is just on renewed optimism, given the fact that the demand for iPhone 10, or what everyone's now calling iPhone X, is quite high. We saw queuing outside the stores ahead of this release. So the iPhone 8 in itself, people were correct to assume that there wasn't much interest in the iPhone 8, and in fact people were waiting to buy the iPhone 10, and you know, with these reports as well, supporting Apple share prices now trading around $168. Okay, so if we then flick to the charts and look at cable, well, this was an interesting move. We had a hike and sterling depreciated. So this is tightening of monetary policy conditions and the domestic currency in itself weakening. Where do we see this previously? Well, we saw this in the euro dollar. So interesting time to be trading. Now, this was a difficult event, I think. Oh, thank you, Samuel. This is quite a difficult time to be, difficult event to be trading, but what you could have seen coming into this event, there was market expectation was for a 90% probability of a hike with a 7-2 split. I think 7-2 was overcooking it a little bit, given the fact that, well, the predicament faced by the Bank of England, whether they squeeze consumers by lower real wage growth or by increased repayments on debts with higher interest rates. It was sort of the lesser of two evils to hike interest rates to start to stem inflation, rather than letting the consumer get squeezed by their real wages falling. So I think the trade-off was there, but I think that I was personally expecting more of a 6-3, so we saw 7-2 and we saw immediate upside. So going into this, I would have thought 7-2 would have seen a bit more of a sharper move higher. That didn't materialize, but you could quite quickly see, as soon as the data was released, that this was in line with market expectation, because if it wasn't in line with market expectation, the market would have jumped a lot further. What became quite difficult about this trade is then the comments in the minutes. A lot of people, including myself, would have gone long this pivot level here. looking for a little bit of an extension higher, albeit given the fact that this was market expectations. But I thought looking at R1 or the high of the day would have been realistic. And then sort of the dovish commentary started, and I imagine there was a few stops underneath the pivot as well. So we blip higher, a few stops get triggered, and we accelerate lower. And then we continue to stay under pressure all the way to the end of the session, now down here testing the lows as we speak. Now, this being said, there were some tradable opportunities. If you took it more into a sort of technical level, one thing I did do is draw up a fib. I actually quite like drawing fibs on events like these where there is very little discretion to be applied to the highs and the lows of the move. And this was one of these situations. Let me just... Okay, well, it doesn't look so promising now, but at the time, sort of looking to get involved around here. Maybe my fib was looking a bit different at the time. But just given the fact that there was a lack of discretion to be used in this Fibonacci, I thought it would be a good place to sort of draw it up. And let me just delete this, try to fit it a little bit better. By the way, what I'm doing now is the absolute reason I generally don't like fibs, that you keep drawing till you find something that fits. Anyway, so loosely 38.2% coming in around the same area as the 13150. Finally finding some resistance around here, ranging, and then we broke down lower and reclaimed the previous low, which was a 1.31 level. A little breakout here coming into the late afternoon, and the market continued to decline up until we went to go test these sort of mid-October lows. So yes, the initial move was painful, but had you kept a clear head about yourself, and especially stage 2 guys and sort of stage 3 guys, I wasn't really watching the stage 1 guys, but there was opportunity there. And I understand that this would have been a difficult move to stomach, but if you keep a clear head, level head, there are opportunities there. There was a breakout here, a retracement here. And in fitting with most sort of monetary policy events, you'll see a big move in a consolidation. A consolidation is just people booking some profit, market just cooling off a little bit, reevaluating all the comments that were made, and then looking to sell in. But ultimately the trend was decided. We saw the top of the consolidation, and this in itself would have worked as a good place of entry, coupling with the 1.3150, looking for the short, first target being the low of the range 131, second target being the low we just previously discussed. Okay, so what actually caused the move lower? Well, this was on a couple points here. So within the commentary, there were sort of 3 things that were addressed. There was removal of the forward guidance on yield curve. Basically, the market is currently priced for 3 hikes up until 2020. So if we transition and see what this looks like. Looks like this. So 3 hikes up until 2020, which obviously isn't very much over 2 years. Which is one aspect, and they didn't sort of say whether their market is underpriced or overpriced on this matter, so they sort of stayed pretty neutral on that. I think the more important things that the market responded to was the fact that this is Mark Carney saying that this is a reduction of productivity and not growth as to why they needed to hike interest rates. And third of all, they said the policy will be dependent on Brexit negotiations. And that's just been a disaster so far. No real progress made. So if future monetary policy decisions or MPCs are going to make decisions based on negotiations with the EU, well, all we can look at is what's happened since March. So it's gone March, April, May, June, July, August, November, and nothing has happened. So market is basically saying, well, we've lost faith in these Brexit negotiations going well, therefore we've lost faith that we're going to see any hawkishness come out of the Bank of England. And this really does look to explain the move lower. Plus the fact that, yes, we're getting higher inflation, but every other metric from the UK is deteriorating. Today's going to be particularly interesting. At 9:30 we have the services PMI. Services making up a huge majority, 70% of our economy. If we get a miss on that, again, this will propel us through these lows, I have no doubt. And then looking at cable on a daily, I'm sure Ant has shared this chart before. So if we break through these lows, well, the next level that he has marked up is the 1.3. The 1.3 obviously just being a handle, so a psychological handle. However, in itself, it's not a great area of technical resistance or support. The market has traded through this frequently over the past few months. So yes, it would be a good place to be looking to take profit. But if we get through there, the next natural support line comes down at 1.2783. So this wouldn't happen immediately, but really that does... Thank you. So as I was saying, we get a lower services number. We'll break through these lows. After that, 1.3 being the next psychological handle. But yes, we've seen some resistance, but the market has comfortably traded through that on a number of occasions. So if you do go short, that would be a reasonable place to look to book profit. 59 ticks after services PMI is well within reason. Looking to scale out some of your position there, if not majority. But over the medium to longer term, continuing deterioration of UK economic measures. Markets largely taken the hike as a dovish hike, so there's not sterling strength coming from that aspect, and the market can very easily continue to drop lower until sort of these lows where we do have some technical points of support and resistance. And for the more experienced guys, you're more than comfortable to see why this is a significant level. But for some of the newer guys, a technical point is where we've either seen buyers or sellers come into the market. So we were selling off, the bears were in control. Over here, the bulls felt that this was underpriced, the bears felt that this was fair value or looked to book profit, and then bulls, people driving the price higher or expect the price to go higher, take over. So this means that this price point, 1.2783, is a price which is interesting to market participants. This, you can see, was also the case in June, as well as in April, May, as well as in December. So if we do get through these levels, this is the next area of interest where we may see another swing in the market or bulls taking over. So very interesting to see what happens today at 9:30. So that's your UK data done. Also, we have non-farm payrolls today. So with regards to non-farm payrolls, the market is expecting quite a wide swing. Let me just look at the data calendar, switch that over. So NFP coming in today. So number today is...
So next up in 10 minutes time.
Non-farm payrolls. Expected 310, and this is obviously quite a sharp bounce from the previous month of minus 33,000, following the effects of the hurricanes. So seeing this expectation number is a sharp bounce. That being said, the general market, there are expectations on the lower side of 120 all the way up to 400,000. If we looked at what happened with Hurricane Katrina, it took a couple of months for the jobs numbers to sort of come back to some sort of normality. So the headline is going to be definitely watch out for it, and you will see an algo spike either way if it's a beat or a miss. But given the fact that the market participants, the range is so big from 120 all the way up to 400,000. If we get, let's say, 300 or even 250, which is sort of your average for many months looking back, I don't feel the market's going to react to that number, coupled with the fact that, as we discuss quite regularly, unemployment is at record ever lows, 4.2% expected this time. So that's a very healthy employment industry, almost too healthy, running into the danger of being an overheated economy over here. So that jobs data, for the newer guys, please be careful. You're really looking, I'd say, if we're getting, the only time you'd see a sustained move is if we start getting above 400, so above the maximum range, or on the lower side, sub 100. And even then, if we get a reading of sub 100, given the fact that we are still seeing a filter through from the hurricane, you may not see a sustained move. Average hourly earnings obviously taking more importance. Expectation of 0.2%. This is following a 0.5% reading last month, and this you could sort of understand as we saw a reduction in jobs following the hurricanes. This would have been in sort of your the lower paid end, therefore the average hourly earnings over that period would have been higher, as the people sort of earning the higher wages wouldn't have been affected as much by the hurricanes. So again, market did sort of shrug that number off. So coming back to our sort of average hourly earning ranges of 0.2% expected. Now, if you start seeing a healthy number such as 0.4%, then I'd be looking to get involved. But again, not committing huge amounts of capital. I think we're priced for a December hike. We are comfortable that we're going to get 3 more hikes going into 2018. Nearly every other economic measure apart from inflation in the United States is solid. Consumer sentiment is solid. Across the board, the United States economy is healthy and is growing. So that's one aspect. The other aspect is average unemployment is at record level lows. So net, I don't feel like, unless we start to get a reading above maybe 0.4, 0.5, will the market really look at this and then say, okay, now I believe that this higher reading in average hourly earnings will filter through into a really inflationary state. And that's why I'm saying 0.4, 0.5 or above. If we start seeing average hourly earnings starting to rise quite sharply, then we'll see inflation has the ability to gain quite rapidly, as we saw late into 2016, that when inflation does pick up, it can sort of spiral out of control. So there's that metric which may cause most volatility. Otherwise, just be careful. I'd largely ignore the headline. Average hourly earnings, we start seeing +4, then definitely look for a break of the ranges. And just quickly, let me get the services PMI UK economics. This is the upcoming data, services PMI. As you can see, services PMI number is starting to deteriorate as well. So keeping a close eye on this. Just having a look at sterling as we speak. It looks like, looks like we're going to go in for another test of these lows. What else in there? 2 o'clock ISM manufacturing PMI numbers coming out. Given the fact that these are going to be post non-farm payrolls, they're going to be less impactful. A number of data sets coming out, but your headline obviously taking priority. Otherwise, we have Fed member Kashkari speaking as well. Participates in the question answers. That's going to be at 4:15. That's going to be interesting. But otherwise, it's going to be a quiet morning. Looking for most of the volatility at 9:30. UK services PMI, then your non-farm payrolls, and then in the afternoon we have the ISM. But one thing I would say, coming into Friday, as with every Friday, come 3:30, 4 o'clock, market really does start to die down. So anybody who has taken some losses, we will see some opportunities. Some people will make money, some people won't make money. If you are having some losses, then please don't try to then revenge trade the market, and just to sort of take a step back, reevaluate, and then approach Monday morning with a fresh mind. Okay, guys, thank you very much. Coming up to 9 o'clock. Let me know if you have any questions. I'll be in Trading Live and Trading Room. Thank you very much.